Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm so excited that you have joined me today to discuss how understanding market cycles can help you optimize your real estate investment strategy. Now, before we launch into today's topic, I want you to know that we do the show live every Tuesday to help you learn the ins and outs of passive investing. So if you haven't done so already, be sure to check out passiveinvestingwithwhitney.com. There, I've got some free goodies for you. Also, if you're looking for guidance on how to optimize your passive investing portfolio, be sure to fill out the form there at passiveinvestingwithwhitney.com. You'll get access to my calendar and we can talk all things passive real estate. That way you understand how we can help you achieve your goals. Now, for today's topic, we are going to discuss how understanding market cycles can help you actually optimize your real estate investment strategy. Now, before we dive in much further, if this is the first time you and I are meeting, again, my name is Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I have chosen to invest in real estate and, more importantly, passively in real estate. Now, my journey started off as an accidental landlord back in 2002. I learned to scale several live and flips and house hacks, doing millions in fix and flip real estate transactions, and then eventually into learning how to buy and hold on to those rentals and scale a real estate rental portfolio that kicked off cash flow. And then I hit my next ceiling of achievement, which I ran out of time. I was working a day job, taking care of family, and I needed an opportunity not only to scale my passive or my real estate portfolio, but to do so in a more passive manner. So I transitioned into multifamily real estate and investing, both actively and passively. And really, where we're at today, my husband and I, we have over 6,500 residential units, 2,200 self-storage units, 15 express car washes. Part of this in active holdings that we manage ourselves, but also in passive holdings. And it's really those passive holdings that's helped us unlock those not only financial freedom. I think most people are yearning for financial freedom, not because of the money itself, but what it gives you. And that is because financial freedom, financial independence can give you 100% control and time on how you spend your time, that choice freedom that we all are yearning. And it can help you, but when you have that choice in freedom of spending your time, you can go out and create the impact you were meant to create in the world. And we can actually help you do that here at PassiveInvesting.com. We've been talking a lot about our real estate debt fund portfolio. And we have lent out over $331 million through our lending arm, which is called Rehab Wallet. And then we still have our strong returns in our equity deals to our passive investors. Now, we are going to talk today about market cycles. So nothing today should be construed as financial, legal, or tax advice. This is all education. So if you see something that would apply to you and your portfolio that you want to incorporate into your investing journey, make sure you consult with your investment team before making any investment decision. And as always, you can reach out to me at passiveinvestingwithwhitney.com. Just fill out the short little form there, and you and I can hop on a one-on-one call together, and I can help you understand how passive investing can help you meet your goals, and not just us as a company, but also the investment strategy itself. All right, well, let's talk about the 4 stages of a market cycle. Because in the market cycle, I think investors have had a lot of questions on their mind, like, since we've been in this hypersupply contraction period, recessionary period, even though we haven't called it a recession, what am I to invest in? Okay, I can't find any deals. And that's the thing is, as we move through the different market cycles, the deals actually change. But before we talk about what deal matches with which market cycle, let's talk about the different market cycles and where we are currently at today. Now, this market cycle graph can actually be overlaid onto multifamily real estate, self-storage real estate, business business, ventures, it doesn't really matter. The tech industry, the industrial industry, right? So all these industries cycle at different times, okay? So really the four phases of any type of cycle within a market is that phase one would be the recovery. So you've come out of a contractionary period, maybe even a recession, and things are starting to get better. Credit's starting to loosen up a little bit. Banks are starting to do a little bit more lending. Permitting is coming back online. Okay, things are there. You can see the light at the end of the tunnel. Things aren't rosy right now, but you can see the light, and it's not an oncoming train, right? Then you move into phase two. This is where, everybody loves, phase two. This is the expansion cycle. Credit is plentiful. Banks are are lending, freely in, to different asset classes, vacancies coming down, cash flows coming in. The market is incredibly strong at this point in time. All right, but also during this time, we get a lot more permitting, a lot more, especially if we're talking about, residential real estate. We get a lot more building going on. And then eventually we tip into the hyper supply, okay? In that hyper supply phase, there are too many deliveries coming to the market and new construction starts slowing down, right? Because it's not as sexy in order to build, right? You might get cash flow someplace else. Now we also might start seeing some sort of decline. We might see banks start de-risking their balance sheet. In the case of this last hypersupply contraction phase, we actually saw the Fed raise interest rates aggressively. And by doing so, they sucked a lot of credit or did what we call quantitative tightening, pulled money out of the economy by raising the interest rates. Okay, so what did this do to the hypersupply phase? Essentially, all permitting and construction nearly stopped, right? If people hadn't already broken the ground on their projects, a lot of people were wondering, is it even worth it for me to break ground on this project? Should I just let it go? Jurisdictions were not allowing new permitting to happen, but just people weren't interested. Banks weren't lending on it anymore. So we're starting to see a lot of things get sucked out of the market. Okay, eventually that hyper supply will get absorbed, okay, over time. All right, and then we start hitting into the contractionary part of the cycle or recessionary part of the cycle. Okay, we start seeing more increased vacancy, but also we're starting to see a lot more supply absorption. Okay, now here's the interesting thing, and I don't know if you can really, discover the, delineate this nuance. The recovery and expansion cycles tend to be a little bit longer in a time period. So the last, recovery and expansion cycle, depending on which economist you listen to, actually was either 2009 through 2020 or 2011 through 2021. Okay. But anyways, we're still talking about a 9-10 year period, which is pretty long for a recovery and expansion cycle. A lot of times these market cycles happen in a much more compressed timeline. Now you might have that a recovery and expansion, part of the cycle be about 10 years in the case of this last market cycle, but the hypersupply contractionary period together are not going to be 10 years. Hopefully, okay. They typically to be much shorter in time scale. In reality, probably somewhere between 12 to 24 months. There's been a couple cases in US history in the 200 years that we've been tracking recessionary markets that it's gone a little bit longer than 24 months. But on a whole, the average is actually 6 to 10 months for a hypersupply recessionary period. So recovery and expansion happens slowly over time. Hypersupply contraction typically happens pretty quickly, and then we start moving into recovery again. Now, before we talk about where we are in the cycle, I think we also have to understand credit cycles. Okay, so if you look at this graph, really, we're looking at the same recovery, okay, period, this green period up here, expansion up here. This is our hypersupply and our contraction period, okay, our recessionary period. All right, credit is more readily available in the recovery and in the expansionary part of the periods, okay, banks are more likely to lend. They're probably being incentivized actually to lend. In the case of, the Fed just announced a 50 basis point drop in interest rates yesterday. So we're actually, and what are we recording this on September 18th? What we're seeing is that there's actually an expansion period on the horizon. Banks are going to be incentivized in order to lend. The Fed has indicated they're probably going to do at least one, if not two more rate cuts, probably three in the next 6 months. Okay, they're going to be, it seems like, pretty aggressive about this. Fingers crossed. Okay, so that should stimulate the economy into an expansion or into a recovery, into an expansion part of the cycle. But where have we been? Okay. We've been in this hypersupply contraction period where credit has been less available. It's essentially been sucked out of the supply. And so banks have been de-risking their portfolios, their balance sheet. Okay. They don't, especially in commercial real estate, they don't want to take on any more deals. So that allows the investor more opportunity to come into the market and solve problems. Okay. And so even though we have seen, this cut has been announced, we are still in this part of the trough. Okay. All right. It's going to take a few months. What did they say? It takes about 6 months for interest rate increases and decreases to move through the market cycle. So over the next 6 months, we should start seeing some recovery come online. But right now, we're still in this downward trajectory part of the market cycle. Okay. Where the Fed is trying to create what we call a soft landing for us. Now, that still remains to be true if that's actually going to occur. But we still get to take advantage of this piece right here. And the cool thing is, this credit is investors being able to lend into the credit part of the market cycle or into debt, or take advantage of these type of investments. They're existent throughout, right? Everybody needs credit. As you can see, the whole entire part of the credit cycle, businesses and entities actually need money in order to get their projects off the ground, get them going. But large part right now, it's been more than ever, businesses need availability of those line of credits. Okay, so if we take the credit cycle and we're going to overlay it on top of the market cycle, what do we get today? Like what investments are appropriate for which part of the market cycle? Well, let's start with actually the contraction recessionary period, because that's really where we're at today. Okay. So as we're kind of, because even for the next 6 to 9 months, as that rate cut starts trickling through the economy, okay, we're still on this kind of like downward, heading for what we call the soft landing, right? So in this contraction recessionary period, debt investments are still going to be very attractive. Okay, but what other opportunities are out there for us? If you could pick up distressed property, that's amazing. Even affordable housing, because there's such a demand for it right now, that could be a nice investment. But again, what is super easy for investors that logically overlays on what we're seeing in the market is debt instruments. That could go in, you could invest in something like our passiveinvesting.com real estate debt fund. Other debt-like investments would be, say, promissory notes. We have 2 promissory notes that are open, one on a medical office, triple net lease opportunity, also one on a multifamily opportunity. So if you're interested in those, be sure to reach out to me. And then also preferred equity. Now, preferred equity, let's be clear, is not debt, but it has a debt-like component to it. And so that is very attractive in what we call, contraction and recessionary period. Okay. Then we get into recovery. Okay. This is where, in 6 to 9 months, as these, rate cuts start trickling through the season, through the economy. And if we're expecting 3 over the next 6 months, in the next year and a half, we're going to start seeing this recovery as we move into expansion. Acquisitions then start making more sense, right? Right now, I have a lot of investors asking me, like, where's the multifamily deal? Where's the express car wash deal? Well, right now, in this part of the contraction part of the market cycle, global market cycle, it just doesn't make sense, but it will here very soon, as you can see. And so, if we can take advantage of picking up distressed property right now and with some sort of distress, okay, then we can actually get ahead of that recovery part of the cycle. So acquisitions start coming online, turnaround projects look great. And then even just holding on, picking up acquisitions that we can hold on for, say, 7 to 10 years look great as well. Okay, then we'll move into the expansion part of the market cycle. Okay, so a lot of investors that I speak with actually said, hey, I started investing in passive multifamily real estate in 2015 in value add deals. I want those deals. Well, guess what? You started investing amidst an expansion part of the market cycle. Okay. So those deals will come online. Just give it a little bit of time. Those high yield properties, development projects, even additional Class A properties in very prime locations will start coming online here in the next couple years. Okay. But let it be known, there will become, the cycle will repeat itself. Okay. Will we see the aggressive interest rates rise from the Federal Reserve again? I don't know. Okay. But the cycle happens repeatedly through real estate, okay, and in various parts of the other parts of the market. Okay, so the last phase is the peak or hyper supply phase. Here, it's a great time if you can time the market, which we don't suggest timing the market. We suggest time in the market, meaning buy an investment and hold it. But if you can exit at the top of the market, that's a great time to sell the property, lock in your capital gain, or even refinance and pull out capital. All right. Now, that was a lot of information, but hopefully from this presentation, what you gleaned were like, hey, the real estate market, has 4 distinct parts of the market cycle. It overlays very nicely with the credit cycle. Okay, so you can see what's happening in the market cycle. You can now understand what's happening in the banking system and why credit goes up, why credit goes down. Okay, what is the problem that you as an investor can actually solve? And then as you identify the different parts of the market cycle you're in, what are those investments that are going to be available to you to invest in? Okay. And that's really, I was letting a group know, or, gave a similar presentation the other day, and somebody in the group asked a question. They were like, hey, how do I perfectly balance out a portfolio? And I actually had a conversation many years ago with 10, say, very well-known passive investors that are doing this full time. And they all said they started off wanting to have the perfectly balanced portfolio, but at the end of the day, what they realized is they had to pay attention to the various market cycles and understand what the market was actually giving them and scale their portfolio that way to have assets that would fare well in all different parts of the market cycle. Okay, that way they could preserve their capital, maintain their cash flow, grow their equity, and if they can, get those tax benefits. All right, a couple of opportunities that are open for you. We have our real estate debt fund. That's poised to take advantage of the current part of the market cycle that we're in. You can use it for short-term investment as well as long-term compounding. All right. Guys, if you're here live, don't go anywhere. We're about to start our Ask Me Anything part of the show.